The broadcast is now starting. All attendees are in listen-only mode.
Hi there, and welcome to today's broadcast. So today we're going to be speaking about how to calculate your break-even point, or how to understand a break-even point. Now, I want to talk a little bit about the break-even point. So the break-even point in any business is the point at which the business starts making money from the way up. And from that way, from that point upwards, starts to make a profit. Now, today's presentation is a series in what we call the finance areas of any business, and we believe that there's 4 or 5 different critical components that you need to know as a business owner, and critical components that you need to know in finance in order to manage your financial affairs really well within the business. And today we're going to be talking about the break-even point, or how to calculate your break-even point. All right, so let's get going. So I believe in a summary. So what I've done is I've created a summary on the break-even point itself and what it means, within finances, or within, the business realm, and what it means to you as a business owner. So I believe it's an analysis to determine the point at which revenue received equals the costs associated with receiving the revenue. So the break-even analysis calculates what is known as a margin of safety, or the amount that the revenue exceed the break-even point, right? So once you've done that, so this is the amount that the revenues can fall while still staying above the break-even point. Now, in some cases, as an example, a lot of businesses are below the break-even point. So the easiest way for me to explain the break-even point is simple. It's how much it's costing you every day, every week, every month in order to, run the business, or open the doors, should I say. And then the break-even point is, there's a point which I'm going to show you on the next slide, that then the business starts to make profitability after that. All right, so here it is. So let me just show you here. So in other words, the break-even point it's a loss until this particular point. Now, you've also got your fixed cost here. So from 0 to here, literally there's some fixed cost, and there's some variable costs, which gives you the total cost. And at that point here, right, where you start to say, well, this is how much it's costing me in order to break even, in order to pay things like wages, in order to pay, cost of goods, in order to pay, any variable costs or whatever it may be, this gives you the break even. And then from there upwards becomes the profit. So a break even point also is a number that then helps you determine how many sales that you need to do within your business, and the total units, and how much you need to make in order for you to be profitable within the business itself. All right, now I believe that there's some critical numbers that you need to look at. Number one is total fixed costs for the month. So if you're looking at, a break-even analysis over a 4-week period or over a month period, you need to have the total fixed cost for the month. And now, what are things like fixed costs? So fixed costs could be things like, the rent. Fixed costs could be leases on equipment, or repayments that you've got, maybe if you're leasing the property, or maybe if you've purchased the property. It could be leases on equipment. It could be stock that you're getting manufactured on a regular basis. It could be things like electricity or phone, if you've got a fixed cost for that, a monthly plan for that. It could be any other expenses that you may have. It could be maybe employees' expenses. So, if they're on a fixed cost, or they're a salary, that becomes a fixed cost and or a margin or a salary, and that is categorized as the total fixed cost. Now, the next one also is then the variable cost for the month. So these are things that maybe, certain variable costs that you're not expecting, or maybe that you are, such as things maybe like rego, any of the vehicles that you may have, insurances, things like maybe if there's some, machinery that's broken down that you need to repair, that may be a variable cost for the month. So it doesn't happen every month, but it's something that you may need to look out for. Maybe it could be a seminar that you're attending. Maybe it could be a business trip that you're going on. These are variable costs for that month. Then the direct cost per unit. So this is really important. So you find out how much it's costing you, especially if you're in the, selling products in business, whether it's online and or offline. There's a unit cost with you purchasing that product in order for you to be able to on-sell it. Purchasing, maybe even if it's service, as an example, if you've got certain service agreements that you're the distributor of that particular service. That could be what we call a cost per unit or a cost per service unit, right? Now, and then the expected selling price. This is really important because you need to know that in order for you to be able to project what your break-even cost is going to be, especially if you're still new to business. So these are very, very, very critical numbers that you need to know. So your fixed costs, your variable costs, your direct cost per unit, and also the expected selling price. Now, let's have a look at some calculations. So the sale price of a unit minus the cost of the unit equals the profit before the expenses. Now, what do I mean by that? So as an example, you may have, you buy a product for $500, right? That's the price of the unit. The cost of the unit is $300. So your profit before your expenses, right? So when you sell that product, if you sell it for 500 minus the cost of the unit, that's 300. Your profit before those expenses works out to be about $200. It's very important to know this number. Now, the next one is the fixed cost plus the variable cost equals the total expenses. So let's say you may have, as an example, $10,000 in fixed cost per month, and you've got $2,000 or $2,500 in variable cost. So that makes it $12,500 in total expenses. You may then have the total expenses divided by the unit profit equals the amount of units that you need to sell. So as an example, if there's $200 unit profit and you've got $12,000 in fixed and variable cost, that means the total expenses divided by the unit profit, so $12,000 divided by $200 would roughly equal about 60 units that you need to sell for that month. So 60 times 200 is about $12,000. Yeah. Now, here are some notes that you need to take, consider. Okay, some questions. How many units do I need to sell to break even, and what does that look like on a daily, weekly, and monthly scale? See, a lot of businesses don't calculate that, and what they do is they end up, really having, a high level of break even, as an example, because of all the costing that they've got. And then what they do is they don't sell enough units. So guess what? They're below break even. They're not making any money, and their profitability is seriously diminished, especially because maybe they're not able to, drive enough leads in order to sell enough on a daily or weekly or a monthly basis. Very important. Number two is this realistic, or do I need to change the price or the product or the service? And here's what I mean by this. If your unit price, as an example in this case, wasn't $200 in net revenue, and you break even, that you need 60 to break even on $12,000 worth of break even over that month, and you're only making $100, it means that you need to sell double as much, which is 120 units for the month. So if you divide that by 30 days on average, that's if you're working 7 days a week, which most of the times we're not, but let's say you are, right? 30 days divided by that is only, if you sold it at $100, you're going to need to sell at least, 30 days, 40 units a day on average, which is 40, that's $4,000 a day times 30, which gives you 400 units a day, times 30, which equals $12,000. So do you see, from that perspective, maybe it's not realistic. Maybe it's too many. It's 120 units over 30. That's 40 units a day. Maybe you're not able to do that. So you may need to either change the price and bring that up. So, the higher the price, the less amount of product that you need to sell or service, or you may need to change the product or service around to be able to, make sure that that break even is being met month in, month out. Now, this is a major problem with a lot of businesses where their sales are too far down, or they're not selling enough, or they're not scalable because there's not enough profit margin within the product or service itself. So it's really something that you need to, ask yourself within the business, and most importantly, make sure you do those break-even calculations using, the examples that we've shown here. Okay, I hope you enjoyed today's series on finances, and I look forward to seeing you on the next, and most importantly, on the upside.